Welcome back. We're staying with a lot of the corporate conversations coming out of the Q4 earnings season, and Happiest Minds reported a sluggish set of numbers for the quarter gone by. Wage hikes for senior level employees impacted margins. Our colleague Mangalam caught up with the company's management and started off by asking about the areas that the company will be focusing on over the next couple of quarters, specifically after the trade deal between the US and China.
I think that was positive because there was quite a bit of uncertainty which was holding customers, especially in the manufacturing, industrial, and maybe even in the healthcare space. So that was a real, positive news over the weekend. As you know, in a month and a half back, when we had our press conference, we had guided that we would do double-digit growth, and that was based on some of the transformations that we had initiated. So this gives a little bit more impetus to what we had guided. We are seeing traction in a couple of verticals, BFSI and healthcare and life sciences. As you see, the contribution from PureSoftware and Aureus, both in terms of revenue and capabilities, has helped BFSI become our largest vertical and show good quarter-on-quarter growth. Healthcare and life science, again, as we announced in our press release, we're able to close 2 SOWs, cumulatively $20 million for this year, and hopefully will give us close to that revenue next quarter as well. We expect these two verticals to drive our growth, and we also are expecting manufacturing and industrial to start showing growth with the deal that's been signed with China.
All right, Venkat, your thoughts. You couldn't meet the FY25 guidance earlier. Now, what is your target for FY26 when it comes to revenues and margins?
So as far as FY25 is concerned, we had talked about 28 to 30% forecast as far as revenues in constant currency was concerned. We are at about 26%. Yes, you said that right. We have maybe a couple of percentage points below. We had already, updated markets and the media about that. As far as margins are concerned, we had said 20 to 22%. FY25, we have ended with 21.4%, well in line with that, guidance that I had given. Adjusted for that one unfortunate bad debt that we had to take in this quarter, our adjusted EBITDA would have been close to 22%. So the upper end of the guidance bracket that I'd given you. So in terms of profit, we are on course. We could do better. We should do better. But these profits are adjusted for the investments that we have made into GBS, the GBS business and the new sales business unit, that sales team that we have put in place, both of which should pull in and start contributing big time in FY26. As far as forecast for the next year is concerned, on the revenue side, yes, we are holding on to a double-digit growth. And as far as profitability is concerned, again, 20 to 22% of EBITDA is a number that we are looking at right now, and would like to try coming in within that, but also try to improve on that front.
Double-digit is a wide range. If you could specify some of the ranges that you're looking at in terms of revenue forecast, and if you could break that down into how much are you looking at it coming in organically, how much of that on account of the investments that you've made in GBS and the acquisitions that you've made earlier as well?
Look at it, we don't specify by the company and the growth because, the acquisitions were completed in the first quarter of last year. So as we go into the next year, we are going as an entire company, Happiest Minds, integrated. Aureus is very well integrated. PureSoftware is integrated at the business front. SMI, which was acquired a couple of years back, is fully integrated. So we are going as an integrated whole for the next year. So it's a full force number that I'm talking about as far as revenues are concerned. In terms of GBS, today their revenue contribution is about 2% of our revenue. So if you take our numbers to be about $250 million, that's coming to about $4.7 to $5 million in terms of direct and influence revenue. We would like that to go up to 25 million over the next couple of years. That's the target because, most of the projects that we do has an impact or an element of GBS weaved into it. On the margins, it's at the company level. Last year when I made the guidance was also the company level. We continue to hold on the same basis.
All right, we take that point. What about utilization? I remember, Joseph, the last time we spoke, you said that utilization increasing is one of the big levers of growth for the company. Where does that number stand, and do you have a target for FY26?
Yeah, so if you look at the utilization, it did tick slightly lower, and that was primarily because of that customer that we had to stop working, where we had the bad debt and which impacted our profitability for the quarter. We stopped work. We had ramped up in Q2 and Q3. It was almost at $1 million, $1.5 million per quarter. So as you can understand, it was a significant ramp down, and that impacted our utilization. We've been launching quite a few initiatives to push this number up. Part of it is also looking at our internal people as we do our performance evaluation, and that's the reason you've seen a little bit of a tick up in attrition, going up to 16.8% from 15.3%. We expect that in Q1 we will get the utilization moving back towards maybe 80 or so percent. We're comfortable with 80%, and that will be one of the levers for improvement in margins.
All right, the attrition is high, but at the same time, there were wage hikes in the fourth quarter that impacted the margins as well. So if you could give us a sense on what the wage hike target for next year is largely, would it be inflation-led, a little more than that, revenue-led? How do you calculate that?
We would like to take that as it comes, Mangalam, because right now we have planned for something which is in line with what we see from the industry. Compensation as practice is more market linked. We have to see what the others are doing in the market, because we have to attract people from there, and we lose people to the other industry participants. So it's largely market led. Right now we have planned on that basis.
All right, and a final question. What is your current revenue contribution coming in from BFSI? You had called out looking to increase that structurally. What's your target?
So I think the current contribution that we have, around 26%, is optimal. My hope is, our expectation is that we continue growing BFSI, but others will grow at the same pace or a little faster. What we are seeing out in the market is that the BFSI segment, along with healthcare, probably is showing the more best traction and green shoots. And this is reflected in the quarter-on-quarter as well as year-on-year growth that we've shown in BFSI, even though quite a bit of it has come from the acquisitions that we made of PureSoftware and Aureus. But we feel quite positive about both of these segments.
Venkat, let me try this once again before we leave. Double-digit revenue growth implies what? 10 to 12%, low teens, mid-teens? How should we look at it?
No, I would like to hold it with double-digit as of this point, Mangalam. Would like to revisit that as we come closer, because while we do make plans and we are quite upbeat given the order pipeline and seeing the numbers flowing in. You don't know that all of these skirmishes that we're seeing across in various parts of the world, the trade patterns and the disputes that you see on the business front, it all has an impact. And at a company of our size, it can mean a percentage, 2-3% here and there, because we're working across a spectrum of industries. So I would like to hold it at double digit right now. Maybe we'll come back with better numbers for you in the later half of the year.
Okay, that was Mangalam's conversation with Happiest Minds. Stocks down about 2.5% right. And the market also is kind of, keeping a little easy this morning, still about 200 low.